Okay, it is 8 p.m. A very good evening to all of you. And I would like to start now. Welcome everyone to our weekly derivative trading Saturday evening entertainment. Um, Let me just check. Uh, can you all hear me? Can someone just unmute and say hello, please?
Hi, Sam. Hello.
Hi, Zhongyuan. Good evening. Thank you. Now, what I want to do tonight, so since a couple of weeks ago, um, I so every Saturday evening when I sit down with you guys and we talk, I do review what was covered in the lecture. So that's kind of backward looking, and then sometimes I look at the quiz, which is forward looking, and whatever I share with you, it's driven by those two exercises. Okay, so I'm not going to tell you what's in the quiz, but it's on the back of my mind. So this week, I want to just tell you a little bit about spread trading and option spread trading. I really like the lecture notes. I think it's very clear and very simple. On a topic like this, if somebody wants to, they can write incredibly complicated stuff. But I think it's been made as simple as possible. Simple, easy to understand. Okay. Now, I want to try and tell you a story about a company called Integral Investment Management. You probably never heard of that. It is interesting for a couple of reasons. The first one is that it may make you think about your group project that you're doing. This is a real story. Okay, this really happened. Number one, and number two, I think there are important lessons to learn when you are, say, you are a corporation and you have a lot of money to invest. Your company has a pension fund. You have to give it to somebody. Who do you give it to? So it would be a fund manager of some kind. How are you going to conduct your assessment, your due diligence? Okay, so this is I think there are some lessons to learn which can be relevant to your project. I think this is a good time for me to tell you this story. Okay, and if we have time, I'd like to go back. So there are a number of topics that I would like to share with you on previous tutorials. We never had a chance, so let's see if we get there this evening. Okay, including the just quickly revisiting the calendar spread or futures role. That strange case with SocGen a few years ago, and I told you about that. Now for housekeeping, so we have now had 2 quizzes, and there are another 2 coming. So I hope that by now you are used to the format, and I do hope also that the group project is going well. Now, so there is the new course outline. Not much has changed, but I think he updated it. So we are in the middle of quizzes. Know that some questions are multiple choice. So A, B, C, D, you just pick one. But some are what I call MA questions, where A, B, C, D, one or more answers can be correct. Okay, now I have I hope you appreciate this, but I have actually in the heading of the question made it very clear whether it is an MC or MA question. It's very easy for you to tell. Even if I don't tell you, you see a question, you start pressing the different buttons for the different choices. If you are able to choose more than one choice, then you know it's an MA question. Okay, but anyway, I have been letting you know.
Sam, I guess we couldn't see your screen.
Oh,
we can only see you.
Oh, I'm sorry. Thank you for letting me know. Happens all the time, doesn't it? I tell others, and then others tell me. Is it better now?
Yes, we can see it now.
Yeah. Now I got some feedback. So yeah, anyway, I was just talking about this. The previous page, nothing. Okay. Now I got some feedback. People saying that the last quiz was hard. And I had a discussion on this with Robert. Next quiz coming up, we'll give you an extra 5 minutes. And the first quiz had 5 questions. Second quiz had 7 questions. The next one will have 6, but we give you 5 minutes extra. Okay. It is to some degree a speed game. So you can challenge students by the level of difficulty of your questions, but you can also challenge them by a time constraint. That's another way. Okay. So if you know your material, so it means you have to know your material very well. I am aware that last time some people did not do so. I ask you not to worry about that too much, honestly. Okay. Still, somebody got a 9. I think the highest score was 9 for quiz number 2. Okay. So some people, so that person knew the material very well. One more thing. So you know how for the Tuesday lectures, there are 3 things for you to keep in mind. So punctuality, so be on time, please, and then turn on the camera. And then also, look, just speak up. No need to type. I think Robert really doesn't like that too much. Actually, I would prefer. I'm not so averse to you typing, but I would prefer that you speak out for your interests. Okay, because soon you are going to have to do that. You can't. You really just can't stay quiet in the background like this in a meeting. Otherwise, you won't get noticed and your ideas will not get communicated. And you can be very, very smart, and a lot of you are, but nobody knows. But my point is this, regarding the quiz, it is especially important that you do the middle. You turn on your camera. I want to say this now. I want to be on record, say it in public. I know some people are not attending the tutorial. That is not my fault. I want to make it fair for everyone. Okay. So if you come to a quiz and we ask you to turn on the camera and you don't, we reserve the right to apply a discount. How do I know that that person behind the dark window really is you? How do I know you're not getting help from somebody? How do I know there isn't another seafood sitting right next to you? So it's really, think about all those things, okay? We would like you to turn on your camera, and we do check, and I do check that you have done that, please. All right, and most of you are doing it. Okay. Okay, now, so you know that there is now a third theme that we have provided, and there is a new outline for the project in Blackboard. Deadline is the 30th of May, which is just one day before the last lecture. No, actually, it's the last lecture is one week before that. So the 1 day before the last time we meet. Okay. Peer review is applicable. Every member should speak. Now, you should by now know that we will pay some attention to your presentation skills and whether you are able to explain an idea clearly and confidently. So don't feel you have to come down with a ton of PhD thesis type knowledge, going down every single little detail. It is a matter of judgment, how much details you want to provide. I think you should always provide enough details so that if you are challenged on a particular idea, then you are able to defend yourself. I think that would be sensible. Okay? But don't feel you have to tell the audience just everything there is to know about your project. There is not enough time for that. Okay. Robert has provided 2 links, and he asked me to share these with you, and they are here. This slide deck is already in Blackboard, so you can download that later. He wants to, well, you don't have to watch it, but it'll help. Hopefully, it also helps to boost your confidence. Okay. We can just do a few minutes. Let's see what this one's about.
Your work can feel much smoother with Monday.com WorkOS. This smooth. All you need to do to get started is choose one of our templates, add your teammates, and you can manage all your work in one place.
Hey practitioners, today I'm going to be teaching you, with the help of my friend Dana Bluen, the top 7 tips for a great presentation. Dana Bluen is an entrepreneur currently living in Bangkok, Thailand, where he is a co-founder and CEO of a company called Mango Labs. Anyways, here's some of his tips. We all have to give presentations at different points in our life. That might be for school or work or an organization that you are involved with. No matter where we give the presentation or to who, we want to make sure that it has the impact on the audience and that it's memorable. These are 7 tips that are going to ensure that you nail
the well, look, watch that in your own time at your leisure. I think the thing that I found over the years with students from Asia, and I don't mean just Chinese, but Asia in general, is that I think Asian students are very smart and they know their stuff, but they're not confident. I don't know why. They somehow, for some reason, when they stand up and talk, there's a fear that they will stumble and they get challenged. And of course, when you have a fear, that affects your performance even more. With more, the Western students, it's often the other way around. So they don't always know their stuff as well as some of you do. But boy, they can talk well, and they can come across as confident. So, if you are knowledgeable and you are a good presenter, think of that. You will walk all over everyone, wouldn't you? Don't you think so? So all the outstanding bankers that I have ever met, they are all great presenters. I don't think it came natural. For some of them, it may be natural, but this is something that you can train up over many years, which is why we always encouraging you to participate. It's all related. All right. Okay, now, so here's the calendar. This is where we are today, and we meet a couple more times only. So a couple more Saturdays, and that will be it. And also we have 2 more lectures. So that means you're going to get quizzed on. So next week you get quizzed on this lecture, and the week after you get quizzed on this lecture, and then that's it. And then we will have our presentation on May 31st. Okay. These are the links to all the videos if you want to have a look at it. Now, I want to just share with you some thoughts that are relevant to trading spreads and trading option spreads, and also some thoughts on Greeks. Okay. Actually, you know what? I have someone sent me some questions, and I would like to answer them first here. Okay, now, so hi Sam, I have a few questions regarding the material of capital markets and derivative trading. This is on derivative trading. Please tell me to have a look when you have time. What is open interest? And I also have a question regarding the impact of time to maturity of the European put price. Let's deal with the first one. Now, open interest is very simple. So when you are trading, open interest is a term that applies to futures contracts. And when 2 persons get together and they want to trade a futures contract, so when you are buying something, there has to be a seller on the other side. So if you are party A and there's someone else, party B, and let's say you trade let's say an oil contract, an oil futures, where you go long. So at some point in the future, you're going to pay, I don't know, $110 for a barrel of WTI oil. let's just say, now if you trade one contract, it's actually 1,000 barrels. So it's 110,000. So it's around, it's just a little over $100,000. That's one contract. If you do that, then on that day, the open interest, the number of the open interest will go up by 1, okay? Not 2. They don't double count. That is open interest. If the day after you decided, okay, I want to close out this position, so maybe the day after oil price goes up to 115, and you decided that you want to, so you made $5 profit and you can close out. So you held a position just for 1 day, so you close it out, and maybe, okay, so there is another. So originally, there's you, A and B. So you traded oil on the long side. So you're going to buy oil, WTI. You pay 110. Now, maybe, just maybe, there is another party, party C, who traded with party D. And let's say they actually traded at an earlier time when the oil price was 105. Okay, let's just say 105. So now it could be that the price now rises to let's just say 115. So party A is very happy, and so is party C. The party D, who is short, is feeling miserable, and so is party B. So party D is even more miserable. So now, and because when you are in an exchange, so there are thousands of people trading with thousands of other people. So it is quite possible that maybe A now wants to sell in order to unwind, and maybe D, who had a short position, suddenly they want to buy. So it could be that A is now selling and D is buying. Now, you never know who's on the other side, and you don't need to, okay? My point is, for this trade, so the open interest will go up by 1. So here the open interest also goes up by 1. But if A then starts to trade with D, then the open interest will go down by 1, because now A disappears from the exchange, and so does D. All right. And then, so that's open interest. Now I actually can show you some real figures. So I have Bloomberg open here, okay, and let's just say now if you just type CL1, so that is the generic nearest contract for WTI crude oil, and you can go CT, which is the futures contract table. And if you come down here, you can see now this is actually like a term structure. We have backwardation. And we discussed this earlier this term, if you remember, and I tried to explain to you why sometimes the futures curve is sloping up, which is called contango, and sometimes it's sloping down. And I'm sure you have had a lot of coverage also in derivative market, and we have talked about that too. So I'm not going to repeat that here, okay? Except by saying that when you have a curve like this, it means that right now, right at this point, the market is in need of this commodity far more than in the future. But the point is, so for the contract maturing in June, this is the bid, this is the ask, and these prices are very wide because these are probably closing prices. It's a bit bullshit here. It's never that wide. 43 point bid, no way. But the settlement price was 110.49. Now here is the open interest. All right. So that means there are 134,000 contracts active for June maturity. And you can see here for July, it's actually 200, almost 250,000 contracts, 236,000 contracts for July. Traditionally, the two most active contracts actually are the one in December and then the middle of the year. June or July and December, they are the most active ones. So you can see that the July contract actually has even more open interest than the one in June. One reason can be usually the June contract. Now the problem with oil is that it's a bit funny. So this one is called a June contract. I know that. But if I click on this, or I can try to type the ticker, CLM2. So CL is crude oil, M stands for June, 2 is the year. So we're 2022. So 2 is that 2 at the end. So if I go commodity and description, so the oil market is a bit funny. What do I mean by that? So although, and this is something you should pay attention to if ever you want to be involved in commodity derivatives. Okay, so this is technically the June contract, but look at the last trade. So the last trade date is going to be next Friday, May 20, in 1 week, less than 1 week. Okay, so the oil market is like this. So if it's a June contract, it actually stops trading 1 month before. So you might be wondering, yeah, what happened between May 20 and June 20? What happens in that entire month? Well, this is when they start preparing for the actual physical delivery. See, first delivery, last delivery. So you're gonna. So this is how it works. And I thought to tell you this because you may wonder, why is it that there are fewer contracts for June, which stops trading in May, compared to July, which stops trading in June? Now, the reason is, or one possible reason, is that if you trade any commodity, including oil, if you trade it for speculative purposes, so if you're not really a user, then you don't plan to take physical delivery. So if you are long, then you need to sell this contract and then maybe buy the next one. It's called rolling, as you know. Okay. So if it was me, I certainly would need to. So a lot closer to the final trade date, you will see the open interest of a particular contract going down gradually until only the physical users are left. So they will take delivery of oil, they don't mind. There are people who will deliver and people who will take delivery. So those guys will remain, but everyone else basically have already left the room and gone into the next contract. I want to see if I can show you whether there's a chart on the open interest. Oh yeah, last price. Let's try this. Oh no. No. I don't know how to get the open interest on a history of the open interest on the futures contract. But anyway, never mind. Does that make sense to everyone? So all of that was to answer this one question. What is open interest? But I want to tell you plenty of interesting things. All right. Now, the second question, I also have a question regarding the impact to maturity to the European put price. For American option, the longer the maturity, the higher the option price. Well, you should know why. For American option, why is it that the longer the maturity, the higher the price? So these are American options. The capital C and capital P. When time goes up, the price goes up. Why is that? There is a very simple, intuitive argument. You don't need formulas. You need reasoning. You need logic. Why is it that for American options, the longer the maturity, the higher the price? Would someone like to tell me? I can imagine that being a reasonable interview question. And it's not really that hard either.
I think that
How a
is
candidate reacts.
because
Yeah, Shufan.
okay. So I guess it's because the American option can exercise at any time. So if it's more valuable earlier than the maturity date, then it can just exercise it. So it must it's at least as valuable. The longer term American option would be at least as valuable as the short term.
Very good. That is the key point. Okay. You have two options, and all else being equal, one of them is 3 months, but the other is 4 months. If they are both American options, this option can do everything that this option can and more. So just for that reason alone, you should pay more. Otherwise, why, if they are the same price, why would I buy this one? I get more optionality. That's the word, optionality. I get more optionality with a longer one. Now, for European options, it's a little different. And so for the European call, in the long run, if the underlying securities pay a large dividend, then the call option would decrease in price. Yes, I agree with that. What you can do is, if we go a little bit deeper on this, so if this is today, let's say you have a call option, 30 days, and another one which is 60 days. But let's say there's a dividend payment somewhere here. So your spot price right now, maybe $10, and your forward price, so your forward price, and options are priced off forwards, not the spot. So it would be equal to $10, 1 plus the interest rate. I'm using simple compounding, okay? Forget the continuous stuff. Minus the dividend. For this option, Q is 0. Okay? But for this option, Q is not 0. So therefore, your forward price can drop. So when your forward price is dropping, that would hurt. When forward goes down, call price goes down. Put price goes up. Okay, so that's for call. Now, however, for the European put, it's the reason there's a question mark here means that it can go either way. Think of a very extreme case. Let's say there's a put option where the strike is $10, all right, but the price of that stock is now $1. That can happen. Okay, we don't need to ask why, but if that happens, and try and price it. So because it is so deep in the money that it would have a delta of 1, so you are practically just short. So price option price.com. I'll just give you a simple demo. Yeah, so say the underlying so exercise price $10. If the spot price now is 10, okay, so I'll stick with 100. Sorry, easier to read. So so if it's at the money spot, now look at the put option. Okay, so $2.69 is the put. But let's say exercise price is 100. But look at the put option, okay? But the actual price of the stock is now 50. So you can see that the put option is $49.63. Now, what actually is that? I tell you what this is. This is actually close to discounting the $50 intrinsic value at an interest rate of 5% per annum. And if now you increase the tenor to 60 days and nothing else changes, look what happens to the put price. It is currently showing 49.63. That's for 30 days. For 60 days, 49.26. It's actually gone down because it is so deep in the money. You are practically just discounting it. So the longer the maturity, the longer you need to wait in order to exercise that for your $50. So if the maturity was tomorrow, I mean, that's what you want. Practically $50. All right. So that would be one way of explaining it. And I like it when you ask me questions like that. For me, the challenge is not only to answer the question, but to answer it in a way that people can understand. Now I'll give you an example of the call. So for the call, I'm just going to do at the money spot. And let's just change the interest rate. So I'm gonna have okay, this is what I'm gonna price. So I'm gonna price a 30-day call, where the strike is 100 and the spot price is 100. It doesn't matter, okay? But there's no, so interest rate is 1% and dividend 0. I'm going to price another one, which is just a little longer. So all else being equal. But now I'm going to put on a whopping big dividend. Now, what does that mean? That means if you look at a timeline, so this is now, this is 30 days, and this is 60 days. So it is projected that somewhere here, there will be a dividend payment of 15%. So now let's take a look at these two options. Okay, so common sense tells you that longer dated options should have a higher price. Well, should they? I think sometimes this gets in the way. That's the point here. So if you price dividend yield 0, 30 days, I'm going to leave the volatility alone. So call option around $2.90. Look at the call option, not the put. Okay. So now I'm going to do the other one. So remember the number of the price, $2.90. Now I'm going to price 45 days, but whopping, let's put 20%. Okay. Let's really go for it. What's the price? $2.42. Okay. So it's all it's the dividend actually just causing a price jump. All right. I will mention one more thing, and you should remember, because I have told you before, but this is a good time to mention this. This is a website called optionprice.com. It's pretty simple, easy to use, and indeed, when you price an option, these are the inputs that you need. That's a standard derivatives 101 job interview question. You know that, okay? Never mind the rounding and the graph increment at the bottom. Don't worry about those. But the key inputs are, if you don't count the strike price, there are 5 elements. So obviously the spot price itself, the tenor, interest rate, dividend, and volatility. Now, so price is price. Tenor, boring, okay? Tenor you can observe, you know how many days. Interest rate you can observe. Now, volatility, yes, it is a market consensus. That's why we say implied volatility. You can imply the volatility back from the option price. You can do that. Okay. Dividend yield. One of two things can happen when you are pricing an option on stocks and you need to input the dividend yield. It could be that when you are pricing an option, so this is now, and this is expiry. And let's say there is a dividend payment. Now, look, either there is or there isn't. If there isn't, if there is no dividend payment, then this field is 0, right? But if there is a dividend payment, then one of two things can happen. Either you know it or you don't. Because if this is the dividend payment, so typically they announce it in advance. So let's say they announce that this is the dividend or earnings announcement. But at this point in time, you don't know, do you? You don't know that. So what the hell do you do? What do you put in this field? You don't know. It doesn't stop people from guessing. So I think it is fair to say that when you are pricing an equity option, and in fact, a lot of these other parameters are, so the price is observable, strike is strike, tenor is tenor, interest rate is observable, volatility, you can get a market input, but in the end, the market has a view on what the dividend should be. It could be 3.52, who knows? Okay. But when you don't know what the forthcoming dividend would be, this is actually just an estimation. That's really my point. And that can change. That number can change. And an implication of that is you actually can use derivatives. Please listen to me. You can use derivatives to express a market neutral view on what you think the dividend should be or will be. And that was the whole point about that SocGen case that I was telling you about early this term. Okay, so you can use an almost market neutral, I mean, you can just use futures. You don't have to use options. Futures would be easier, but you can use futures contracts by way of a calendar spread or calendar row to express a view on what you think the dividend yield should be. If you think the market is wrong, then you can use consecutive futures contracts to express a view. And we went through that when we discussed the SocGen example, where some traders were just at that time, it really was an arbitrage. So some smart traders just massively arbitraged the entire market because they realized after SocGen announced the disastrous loss from one of the traders, there's just no way that that bank can pay a dividend in the next in the next payment date. But the market was still pricing in a dividend. Actually, I already told you about that case early this term, and maybe you can go back to the slides and have a look at it. So I wouldn't waste your time doing that anymore. All right. Any comments from anyone? Anything you want to tell me or ask me? That trading case related to SocGen is in slide deck 4T. So we covered in tutorial 4. Okay, so you can have a look at that. All right. Now I want to come back here. Okay. Just want to go over a few things. First of all, just on the vocabulary, when you are trading option spreads, whatever it might be, so bull call spread, bull put spread, bear call, bear put, that bull bear, that label is it represents your view on the market if you are actually long this setup. Now, what do I mean by that? I'll give you a very simple example. So let's say the spot price of something right now is 100, and you are long a call at 100. You are short a call at 105. Now, my first question to you, if you do that, do you need to pay money, or does someone pay you? And what? You can still earn participation points, huh? So if you trade this, never mind what is the 10, let's just say 3 months, it doesn't matter, okay? Let's just say 3 months. If you trade this, do you pay for it?
Hi, Sam. I think I pay for it because call it 100 is more expensive.
Very good. Excellent, Hanya. Look, guys, I don't know if you're shy or you don't know, but for for next Tuesday night for the quiz, you need to know that, okay? So thank you for that, Hanya. Now, so you pay for it. Hold on. In fact, the payoff is just like this. Now that's a classic. I'm drawing this in a very crude manner. So that's 100. So if you had just a call option, then of course it goes to the sky. But because you sold another one, okay. So clearly you want things to go this way. So number one, you paid. And number two, you want it to go this way. So therefore you must be long, but you pay something. When you go long, you pay for it. So you must be long a bull spread. What kind of spread? Well, you're dealing with calls. So you are long a bull call spread. Okay, so that's what I meant by the first bullet point. that bull bear thing, it represents the point of view of the party who is actually long this setup, and you are long because you paid. Okay? The other party is not selling a bear put spread. No, if you are long a bull call spread and you're wondering what is the other party doing, the one who is selling me, well, they're just short one. So they are short a bull call. That's it. Okay, so don't. I see this confusion quite often. They think, oh, I'm long a bull call spread. The other guy must be short a bear call spread or bear push. No, you long this, you long an apple. The other party is short that apple. Okay, so you pay for this with a view of market going. So beware of that. Okay, otherwise you will struggle with your quiz. Now, so there's bull call, bull put, bear call, bear put. I just gave you one example, so you can work out the other three. Okay, and you should become familiar, and you should try to understand the different boundary conditions. Okay, now what do I mean by boundary conditions? Another way to say that is just the break evens. Give you a couple of examples. So if you buy a call at 100 and you pay, the call is $3, then where is your break even? That should be very simple. You buy a call, strike 100, and for that call you pay $3. What does your break even equal to?
103.
Very good. Was that Shirong?
Yes.
Thank you very much. It's just your strike price plus whatever you pay for it. Okay, so you are praying to your lucky stars that at maturity the price is going to be bigger than this. Now that's boundary condition. When you start dealing with spreads and box trades, there are boundary conditions everywhere. So for spreads, you have to know when you start making money. Oh, I give you another one. Okay, I'm just thinking these up as we go along. So there's okay, let's try and make it interesting. So you are trading a call spread. Let's just say a call spread, and so there's strike X1. X1 is here, and there's strike X2. So you're long this one, and you are short this one. What is the maximum amount of money that you can make with this call spread? If I ask you to give me the exact formula, that can be another cool interview question, don't you think?
Is it x2 minus x1?
Keep going.
And minus the cost of this strategy.
Very good. Well, then give me the actual. Give me the. Do you have the details? What do I write here? This is the premium.
Okay, it's CX2 minus CX1.
but I'm long this thing. Which one is more expensive? Oh, sorry, I will mention one more thing. So let's say the spot price is here right now. But actually, even if I don't say that, you know that buying the call here is more expensive than buying a call here. So it should be, oops. Importantly, with a bracket around it. That's what you were thinking, wasn't it, Shufan?
Yes, sorry, I didn't notice that negative sign, a minus sign.
Minus signs are important. You understand?
Yes.
Yeah. Okay. Just training you guys up. Give you another example. So we're just having a bit of fun here. Let's say so you okay, now let's talk about a put ratio spread. Okay. Let's say let's use oil as an example, WTI. Now WTI is currently around somewhere around 110. Okay, so one barrel of oil of the West Texas intermediary variety costs you $110. Of course, when you go to the gas station, it costs a lot more than that. Okay, but 110. Let's just say you buy a put, you long a put at 109, and that put cost you $3.60. So you got to pay for it. Okay, it's just a 1 month put, or it's not important. Okay, so 1 month put, and then you sell 2 times. You sell 2 puts at 104.50. And one put is equal to $1.80. And you're going to sell 2 of these. All right. So here's your trade. You're going to long a put at 109, and you sell 2 at 104. And I've given you the prices. Can somebody tell me, if you do a trade like that tomorrow, at what price do you start losing money? At what price do you become nervous? Do you understand the question? So imagine you do this trade for 1 month, and now it is already, today is maturity, it's already 1 month later. You still have this trade in your book. What is it that you don't want to see happen? The trade you have done is you buy a put option on WTI at 109, just $1 out of the money, but you sell 2 put options at 104.50 strike. When do you start losing money? Say it is already very close to maturity now. Anyone wants to have a go?
Hi Sam, is it 100? Because you lose 2 times 4.5.
Very
then you-
good, Han Yang. Yes, I'm impressed. Now, sorry, just giving him some participation credit. You should know that if you have a put option, if you have just a put option and nothing else, so from 109, you start making money. But if you sell another put at 104.50, then it's going to go sideways. Then you are just long a bear put spread, but you're not selling one, you're selling two. And as it happened, when you buy one option, you have to pay 360. And when you sell two here, someone is going to pay you 360. So net, you don't have to pay anything. But your payoff now looks like this. And where is this point? This point is exactly the distance, or double the distance of here and here. So here and here is $4.50. Between here and here is also $4.50. So that makes it 100. So if it drops below 100, you start to get nervous. Are you with me there? Everyone understands what I'm saying? And of course, this is known as a ratio put spread. All right. Now we can come back to that later on if we have time. I can tell you something interesting about the oil market. Now, another thing, just to remind you regarding box trades, know that a box spread is basically completely neutralized, just using different combination of put calls, and because of parity relationship, end up you have locked in a guarantee payment. Either you receive it at the end, in which case you would have paid for it at the start, or it can be the other way around. And you can see that from the lecture notes. Okay, when you have two positions, I think one is a reversal, the other is a conversion. So when you put them all together, it just becomes something that doesn't have any contingency whatsoever. You are locked in to either buy something at X1 and sell at X2, in which case you are making a profit, and then you have to pay for that. So it becomes just a way for you to discover the value of something. If you know the value of the box and you know the value of one combination, then you know the value of the other combination. Now, the lesson I want to just share with you here is options can very often be utilized to manufacture artificially certain structures in order to get around, borrowing requirements or leverage constraints. I want to give you an example, okay? Let's just say that in a certain market, and when I say market, I mean stock market, okay? Let's just stick to stock markets. In a certain stock market, the maximum amount of leverage that is allowed is 2 times. I think that is the rule in the US market. So if you want to buy something for $100, all right, you have to have at least $50 of your cash. And then you can borrow the other 50 from a broker. But 2 times, let's just say 2 times is the maximum. Now, knowing what I told you earlier, which is that options can often be used and magically they turn into something else. For the box trade, it turns into a cash flow. Okay. So how then can you use options to get around this 2 times leverage problem, do you think? So in a case like this, if you just look at this bullet point, if you have $50, even with 2 times leverage, you can only buy 1 share. Even if your broker gives you the other $50, you can buy 1 share at $100. Okay, now I'll show you a way where you can use $50 and you can actually buy 2 shares. Okay. The way you would do that is you buy a call option with a strike of 75. Now, you should know by now, and we should not spend too much time explaining this, but when an option is so deep in the money, it would be approximately $25. I know it may not be, but never mind that detail. Let's just say it is around 25. So suddenly, with this money that you have, you can buy 2 calls with the added comfort that the worst thing that can happen to you is if it falls below 75, you're just going to walk away. But if you did with the original plan was your broker gives you $50, and you came up with the other 50, you buy this stock. If this stock drops to 0, you lose your 50, but your broker is going to chase you for the other 50 and say, hey, where's my $50? Pay me back. But if you do it this way, just assuming that a deep in the money option would be approximately equal to its intrinsic value. It may not be, especially if it's longer dated, but let's just say it is. Then you just pay $25 and you can have 2 of these. Are you with me? You understand? So finance becomes very interesting once you realize there's like 17 different ways of doing the same thing. And some of them the end economic result might be the same, but the way you do it, has different implications regarding, regulations and other constraints. All right. Now another thing to clarify with you, because some people were a bit puzzled. Okay, that is regarding call options and put options. All right. So when you are long a call option, you are always long delta and long gamma and long vega. But when you buy a put option, the gamma and delta are the same. So in other words, when you buy options, you are always long gamma and long vega, sometimes called long convexity. Okay, and you are also long volatility. How do you write the Greek alphabet gamma? Like this. But delta is different. So now what do we mean by, so you need to know how, traders talk. What does it mean when you are long delta or when you are short delta? Okay. When you are long delta, it means when the market goes up, you're happy. Okay. When you are short delta, it means when the market goes down, you are happy. So long delta doesn't have to be just for options. So if you are just running a portfolio of equities with just stocks in it, and you are long everywhere, then you are massively long delta. Okay, but the thing to remember is when you buy a put option, then you want markets to go down, obviously. So therefore, by definition, you are short delta. Is everyone comfortable with this? Please tell me now if you're not.
Sam,
Mm,
so does gamma means convexity and vega means volatility?
it does. It does. And hold on a second. Happy to share this with you, and I can talk for a long time on these topics. But if you go over here, you see these values here. So there's gamma and vega. So vega represents the change in price when the volatility goes up from 25 to 26. I think the prices will go up by approximately 14 cents, 1-4. So, oh, that didn't happen. Hold on. Just change all these back to 1. Yeah, Can you see that? So when I change the volatility from 26 to 25, the price should decrease by about 11 cents. Yeah. Okay.
Yes.
Now, I want to tell you an interesting story about something that happened around 20 years ago. And after that, I'm going to let you go. Now, this is an interesting story. And you can find some details on the internet. I thought to tell you because it does have some relevance to your group project in a way, in an interesting way. And it concerns, there was a hedge fund called Integral Investment Management. I think they are based in Dallas, in Texas. And they were raising money for a fund, a US equity fund that they were going to set up. And they claimed that their strategy could beat the stock market benchmarks, such as the S&P 500, consistently, with a very stable and superior Sharpe, certainly better than the Sharpe ratio of the market itself. Okay, so don't forget the Sharpe ratio is just your portfolio return minus the risk-free rate RF divided by volatility. So it's your excess, basically is your excess return over cash. And if your excess return over cash is always better than the market, even if you have the same volatility as the market, you will still have a superior Sharpe ratio. So these guys claim that they could do that. Well, they did not only claim, so they probably ran their portfolio for a few years, and they demonstrated that they could do this in and out of season, quarter after quarter. And they had audited historical performance supporting that claim and could actually beat the benchmark for a number of years. In September 2011, the fund just blew up suddenly, and they had to tell people, they had to tell their clients that within the short space of a few weeks, they lost 90% of the portfolio value. You can imagine the shock and horror of the customers who subscribed to this fund. One of them was called the Chicago Institute of Art, or Chicago Art Institute, I think. So they lost a lot of money. Now, why is it that an art institute would invest their money with a hedge fund, and a hedge fund of this nature? Now, that's a different question, but they did, and they lost a lot of money. So they complained about this fund to the SEC, Securities and Exchange Commission, in the regulator in the United States. The interesting thing is, what the hell happened? And what actually can we learn from a case like that? Now that actually has some bearing on the projects that you guys are doing. I don't know what strategies you guys are thinking of, okay? But I'll tell you this story, and you go away and you think about what I'm about to tell you, okay? So first of all, the performances were not fake, they were real. So they were not faking their accounts. Although they may not have fully disclosed to the clients what they were doing to get those performances, but the performances were real. Okay, so that's the first point. So how did they get these performances? I'll tell you how. So basically, this fund had a very simple idea of selling deep out of the money options on a leverage basis. All right. So if your fund was, let's say, $100 million in value, and let's say the S&P is well, it's a good number. S&P now is around 4,000. So every 3 months, this fund would be short put, let's say at 4,500. Let's just say, I'm just making it up. So they were, sorry, the other way around. So short put at let's say 3,500, and then short call at 4,500. Now, as you should know, what does the payoff look like? So if this is the market now, then your payoff would look like this. You short the call, you short the put. So what happened? And then they did this on a leverage. So maybe they sold it to, you know, with a notional value of 500 million. They were leveraged. Okay, so far more exceeding the actual value of the portfolio itself. So what is the end result? Well, the end result is exactly what would happen. For a long time, when the market is simply just traveling between these two extremes, and I'm talking, you know, options for, I don't know, just 1 month or 3 months. And I think I mentioned last time that 70% of the time markets don't really go anywhere anyway. Okay, so for a long time, markets were just in between, and it never touched. In other words, these options were never exercised. So maybe by maturity, market goes to 3,800, and then by that time they will sell puts and calls accordingly. But now at a strike of let's just say, I don't know, 4,300 and 3,300 and so on. So just trading up and down like this. And at the same time, they were just long the S&P 500. So for this, you just get the market return. All right. But with this, when markets are stable and not much happens, then every month you're just collecting premium. You know, it's like free money. So no wonder they were able to get S&P 500 performance plus, because they were just collecting premium. So that's the explanation on why they were able to beat the market consistently. What lesson do we learn from that? I'll tell you what lesson we learned. The lesson we learn is, if you put this strategy to a back test that lasts for 5, 10, 15 years, the length of time is not the issue here. The issue is you put this strategy through a stress test through a period where there is extreme turbulence in the market, then you know whether it really works or not. So something can work for 3-5 years. It can continue to work until it doesn't. And for this particular story, it happened in September 2001. Tell me, ladies and gentlemen, what happened in September 2001? You guys,
991.
sorry?
The 991 event, right?
Very good, Cherry. Not 991, 911.
Sorry.
It's okay. So that was a disaster. And so as a result, it just basically went this way. And so basically these guys, they were not necessarily cheating. I wouldn't say that. They just had a strategy which they thought would work forever. But if you're a client, then you should do your due diligence and you should ask yourself, okay, what is the worst case scenario? These things always happen. In the 1990s, there was a very famous case of a bank called Barings, which was brought to bankruptcy by a trader who had a lot of who had massive losses, and he was hiding it. Now, I mean, the story always starts like that. They had losses and they were hiding it. But what kind of losses was he running? He was also running strangles. This is called a strangle, by the way. This structure is called a strangle. So that trader was running a strangle on the Nikkei 225, the Japanese stock index futures. And guess what? Kobe earthquake. So expect the unexpected. That is when we can tell who really is a true master. All right. I hope that was interesting. That was the story of integral investment. By the way, so there's an article here from the Economist that Art Institute took them to court. They were very upset and they complained to the SEC. And a few years later, the SEC did find that there was negligence or even fraud with some of the executives. So sooner or later, these people were gonna get in trouble anyway. Piece from The Economist. It's funny. This is a write-up. I can put it in Blackboard. You can read it if you like. It is it is an interesting case. Stick to paintings. The art. This tells you the story, but it doesn't tell you what the hedge fund did or what their technique was. I told you that just now. Okay. I can put that on Blackboard. You can have a look if you want. All right. You have to sign your attendance before you go. And the attendance, hold on a second. Yeah, you can sign that in the attendance folder between now and 10 o'clock. Do you have any questions, ladies and gentlemen, boys and girls? Is everyone okay?
Oh, hello, Sam. I have a question regarding the project.
Yes.
Our project is doing a strengthening index, and we are going to use the future of the index to hedge the risk. But my question is that, for example, the SHI futures cannot fully hedge our strengthening index because we have adjusted the weights of different stocks. For example, if we are going to buy the index, we should buy 7% of Meituan. However, according to our technical analysis and financial analysis, we would like to buy Meituan at 8% or 9% or more. So our portfolio is not fully consistent with HSI index. So how can so if we buy the futures of the HSI, can we hedge the risk of our portfolio?
Thank you. Good question. In fact, it is a question that can easily be asked by the instructor in a presentation. The way I would deal with that, or one possibility, is you have a portfolio which may have a different beta. So you can try to make it beta neutral by looking at what is the likely beta of your portfolio. And then you then need to determine some hedge ratio between your portfolio and the HSI. Now that's not perfect. I never said it's perfect. Okay. But that is better than not doing it. Are you with me?
Oh, okay. And I have another question regarding the hedge issue. If I buy the options of all the stocks, we can actually hedge the risk. However, I don't think we can make a profit out of the hedge because we are not earning, because we are not going to earn any excess return. For example, if I buy a stock of Meituan and I set a put to hedge the risk, and we are going to make a loss because we have to pay for the transaction fee and the premium and so on. So I'm wondering, is hedge a must for us to do during the trade?
Okay, now interesting question. I will try to respond to it without knowing the full details of what you guys have in mind. So the answer may not be perfect, but I think the point about a lot of these strategies, the point is not about hedging. In other words, if you have some exposure and all you do is you go out and you hedge this risk and hedge that risk, you end up you hedge everything and you don't have any risk. All you're doing is you're losing money on commission and brokerage. Okay. Now, so when you hedge something, there has to be a reason for it. What is the reason? One reason is you are running a market neutral strategy. That's why you're hedging. You're not hedging because you need to hedge. You're hedging because you claim that your strategy is free of market risk or beta exposure. I think that is a very important point because I see some 同学 has written to me and said to me, okay, I'm going to do this and I'm going to hedge this and this and this. I said, well, why are you hedging everything? If you're hedging everything, you got no risk left and you're going to get no return. That's the first thing. So you have to have some exposure, and you have to define what that exposure is. In other words, you have to be very clear just exactly what you're trying to do. And it's certainly not hedge everything. Okay. Now, and like I said, I don't know what I think you guys are trying to do some kind of factor-based portfolio, aren't you? So if you do that, and you have stocks A, B, C, D, E, F, G, and then if you buy puts on all of them, then what is your strategy? I don't think you need to hedge it in that manner, because that will be a complete overkill. That will be going too far. You get my point?
Yes.
I don't think, no, I really don't think you would have a portfolio either for this exercise or in reality. You're not going to have a portfolio with stocks A, B, C, D, E, F, G, and then you're going to buy individual put options on each of them. I don't think so. No.
Oh,
You
okay.
might want to have an overall, what people call an overlay, overlay. So that you can do, that you certainly can do, but you wouldn't go down to the individual stock level unless you are doing some kind of pairs trading. That's different. Okay.
Okay. I get your point.
Yeah.
And after your explanation, I get to this conclusion. I don't know whether it is true or not. We should not buy puts in as respect to every stock that we purchase, but we can buy the futures to hedge the systematic risk. Is this true?
Very good. I think that is, well, it depends on what you're doing, but that is closer to the truth. Yes. I think you understand what I'm saying now. So you don't hedge for the sake of hedging. And some students, they have a mistake. Oh, market neutral, I must hedge everything. Well, no, that's not what we're asking. You may hedge Bank of China with ICBC. You might do that, but that's because the strategy calls for it. If you have a factor-driven portfolio, that strategy does not call for you hedging every single stock. That's the difference. Does that make sense?
Okay. Thank you, Sam.
You're welcome. Look, I think I asked all of you. I don't know how many people are still here. I ask all of you not to worry or get too stressed out by this. Just enjoy the research, learn something, and come to the evening, be prepared, be confident, feel good about yourself, and enjoy it. We're not here to stress you out, to give you a nervous breakdown. We're not here for that. Okay. Please understand. All right, I better let you go. Have a nice evening, everyone. Oh, hello. Yes.
Actually, I have a very small question towards the capital market group project. Can I ask you?
Sure. Why don't I just let all the other 同学 go
Okay, of
unless
course.
they want to stay. Otherwise, you are welcome to leave, everyone. Just sign the attendance before 10 o'clock, please.
So,
So I wish everyone a good night. And I'm happy to talk to you, Zhongyuan, or anyone else who wants to listen in. Yeah.
yeah,
Bye-bye.
so